Good morning, everybody. This is Tim Melvin of the Tim Melvin Deep Value Report with another weekly look at the market from a value perspective. We finally are starting to see some pretty serious selling in the stock market. We've got the Dow Jones off 5% in January, the S&P about 3.5%. A lot of talk in the financial press this week about the bloodbath and the carnage in the stock market. Let's try to keep it mildly realistic. We're still not even 5% off all-time highs in the S&P 500, so it's really not time to get too terribly excited. There is plenty of stuff to worry about out there. The Chinese economy appears to be slowing, emerging markets are imploding, and all of this is weighing on the market. Now, throw a couple other items in there. The retail numbers we're seeing are simply horrible. Everybody was saying that the holiday selling season was going to be strong as we were going through December. The analysts were really talking it up. This has not come to pass. The earnings reports that we're seeing are just terrible. And while a lot of the business went online, they did not pick up the slack from the brick and mortar retailers to the degree that we thought they did. In fact, Amazon actually, for one of the first times in a while, fell short of sales expectations. And all of this is weighing on the market. This is a consumer-driven economy. And if the consumer is not out there shopping and spending money, then, folks, the economy is not as good as perhaps that nice GDP print we saw last week is reflecting. There's also some concerns starting to emerge in the housing market. This has worried me for a little while now after the builders ran up so far in 2012. I really thought expectations were too high. As I drive around here in the Orlando area, I noticed that there's just entirely too many new projects and developments going up. I don't want to say that we've got another grand housing bubble coming, but we certainly have a housing market that's a little bit ahead of itself. Read a report this morning from CoreLogic research firm. They're estimating that although shadow inventory is not what it was 3 years ago, there's still 1.7 million homes out there in some stage of the foreclosure process, and including being owned outright by the banks, that are simply not in the inventory, and they do have to be worked off. That's 3 times a normal, healthy market level of homes in the foreclosure process that are going to hit the market sometime in the next couple of years. Combine that with the fact that the builders have been putting stuff up like crazy up through about November, and I think we've got a lot of excess inventory. Tightening mortgage standards are just not going to make it possible for as many people to qualify for a home loan. And the jobs picture, that's the big story. The economy is not producing enough high-paying jobs to create a wave of first-time home buyers. And that's going to take some of the legs out of what we've seen in the housing market and possibly be a bit of a drag on the economy going forward. We're starting to see it. You had housing starts, new home sales were both down. Mortgage applications are down in December. New home sales fell by almost 10%. It was a fantastic year for new home starts and sales in 2013 compared to what came before it in 2011 and 2012. Housing's better than it was, but it's not great. And I certainly don't think we can count on the housing sector to really give legs to the struggling economy. As we go along looking at the broader market, I noticed something in my morning reading today that's really interesting to me. Warburg Pincus, the big private equity fund, has hired a couple of serious mining professionals, including folks from ArcelorMittal and some other analysts, to make a venture into the mining sector. This is huge. Mining is battered, whether it's gold, silver, iron ore, copper. It doesn't really matter what you're mining. Your stock's not doing very well at this point in time. And there's reasons for that. I mean, China is slowing down. They're one of the biggest users of metals and ores in the world, if not the biggest. The emerging market demand is probably going to go away because a lot of those economies appear to be absolutely imploding. Certainly their equity markets and bond markets are at this point in time. So we're probably not going to see the type of demand that we wanted. Now, this kind of reminds me of the shipping sector last year in late 2012, early 2013. There was no good news for the shipping sector. Again, there were concerns about China. There were concerns about global oil demand in the tanking sector. There was tremendous excess capacity in the industry. But all of a sudden, I noticed that the private equity guys were starting to sniff around the shipping sector. And although initially the sector went down after I bought it, but then every stock I've ever bought in my life has gone down before it went up, I think eventually those things took off as conditions improved only slightly in real terms, but the stocks were so beaten and battered that many of them have doubled and even tripled during 2013. And the key indicator to me that we were getting to a bottom was the long-term private equity investors were stepping in and saying, hey, these assets are just simply too cheap. We need to be buyers here. Seeing the exact same thing in the mining conditions. A couple of ex-JP Morgan bankers have gotten together to form a private equity fund. They raised $375 million to put into mining and mining projects. In the grand scheme of things, 375 million is not a lot of money, but you put that together with the Warburg news, and we're starting to see some folks tiptoe into the mining industry. It may be time to start taking a deeper look at some of these miners that are trading at 60, 50, and even just 40% of book value, have decent balance sheets and the ability to stay in business until the cycle picks up again. That could be pretty exciting over the next couple of years. Seeing a lot of the small bank earnings coming in, and we're getting a pretty consistent picture. Net interest margins are still, they're tight. They're still being squeezed. Not seeing a lot of improvement there. Probably won't for a little while until the tapering process gets a lot farther along. At that point, we start to see spreads come out because longer rates will be up. We'll have a much steeper yield curve as the Fed continues to hold funding rates very, very low. That'll be great for these little banks. The credit picture is continuing to improve. There are less bad loans being created. A lot of the stupid loans made in 2005, 2006 are starting to run off the books. They've either been repaired or they've been foreclosed on, so there's not as big a problem there. Seeing a lot of selling of problem loan portfolios to distressed investors. That's also helping clean up the balance sheets quite a bit. So you've got balance sheet improvement. You've got some loan growth. It's scattered around the banks around the country, but we are seeing some banks report mid to high single-digit loan growth, and that is a great sign for the small banks, particularly those banks that are financing commercial and business loans, because we said I really think that housing is going to kind of slow down here a little bit. That's not going to be a great source of loan demand for the banks. But if they are, in fact, making commercial and business loans, I think you can see some healthy loan demand there as we continue to move into 2014. We also are continuing to see dividend increases all the way across the banking sector, whether it's a large bank or a small bank. If you're a dividend growth investor, you really have to be looking at banks right now. They are going to show strong double-digit sales growth. Revenue growth, dividend growth. I finally got that right on the third try over the next several years. So we had 10 last week. We have 7 this week. Banking sector slowly getting better. Still finding a lot of banks trading at 75, 80% of tangible book value that are just outstanding buys for long-term investors. So we've got a very busy week coming up. We will have the January jobs data on Friday. That should be very interesting to see exactly how the government has twisted the numbers to tell what kind of story. The unemployment rate is forecast to remain at 6.7%, which is just absolutely ludicrous to me with the labor force participation rate where it is. If the labor force was the same size as it was 4 years ago, I think we'd have a almost 12% unemployment rate, and that's kind of what I actually see when I'm out there walking around. But that will be a potentially market-moving report. We have lots of earnings reports on tap again. Toyota, Panasonic, Sharp, Hitachi, all going to give us a good look at the consumer during the fourth quarter of the year when those come out. We have several of the insurance companies, including Prudential Financial, and then the company that tells us all about everything, Walt Disney, will be reporting on Wednesday because they cover just about every segment of the entertainment and consumer population here in the United States and to a different, somewhat degree abroad. So it'll be an interesting week. You got LinkedIn reporting on Thursday. That could be a market moving report. So it's going to be an interesting time. Again, we're sitting here. There's not a lot of safe and cheap stocks in the market. We have a heavy cash percentage in the portfolios, anywhere from the high 40s to the high 60s% of the portfolios are in cash right now because we're simply not finding the opportunities that we want to find. So hopefully we get a little more volatility, things get pushed around, opportunities get created. Until that happens, we're perfectly content to sit here with the stocks that we do own, that are safe and cheap, and have the potential for returns that we can measure in multiples and not just percentages over the next few years. Anyway, it's going to be an interesting week. Should be fun.